it's not about having a crystal ball, what will happen tomorrow. The question is, what is the risk that will happen tomorrow, and am I positioned appropriately?
For a limited time, the Austrian Mint and SD Bullion are offering you a Silver Philharmonic buy 19, get one free coin deal. Officially issued by this storied 825-year-old European bullion mint. These famous European silver bullion products come packaged complete in protective sealed Austrian mint tubes containing 20 coins apiece, or in bulk sealed Austrian mint cases containing 500 troy ounces in each. These guaranteed 1 troy ounce Austrian Philharmonics are official European legal tender silver coins. Each is comprised with a minimum 0.999 fine silver bullion content. Austrian Philharmonic bullion coins qualify for silver IRAs, making them an excellent choice for tax-deferred, long-term bullion savings. Discreetly shipped, fully insured to SD Bullion customers' doors and non-bank vaults. Don't delay. This free silver Austrian Philharmonic bullion coin deal will end soon.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and back with us today is Axel Merk from Merk Investments. Axel, thank you so much for joining us today.
Good to be with you.
All right, now the first topic I'd like to discuss is the Fed meeting. We're recording this right before the Fed meeting. Can you discuss what you expect to come from the Fed meeting?
Well, sure. One of the reasons I agreed to talk before is because I don't expect all that much. Now, obviously, we'll get the new dot plots and all that. Everything gets so excited. But ultimately, of course, nobody expects them to hike this week. The question really is what's going to happen in the medium term. And I disagree with most folks and would think that they're going to hike later this year, and I can expand on that.
Yeah, definitely. Why do you think that they will hike rates?
Well, if you think about it, the unemployment rate is at a very low level. And at the same time, we have the economy rolling ahead. Now, it has slowed down. Some indicators, especially international indicators, have come down. But one thing that we look at is financial conditions. Now, there are many ways to look at financial conditions. Most folks only look at the VIX index, the S&P 500. And when volatility is low, then financial conditions are great. And when markets have a tantrum, then financial conditions are bad. Well, that's not how it works. And notably, that's not how the Fed historically looks at it. It's really about whether companies have access to credit. And one thing I like to remind people, the whole point of hiking rates is to tighten financial conditions. You want to tighten financial conditions because the economy is doing, quote unquote, too well. And if you look at some financial condition indices, we look at the Chicago Fed Financial Condition Index, that one shows as easy as it has ever been in this economic cycle, meaning the Fed hasn't tightened. Now, clearly, emerging markets, some tidbits of the economy have seen some rough spots, but as far as the big metrics are concerned, credit is easy. So the Fed is really still in an easing mode. And so if you think that is justified with super low unemployment, and the question is how many people can you still move from the sidelines, I think as wage pressure is rising, at some point you're going to reach this barrier that you cannot pull people from the side anymore. Nobody knows when that is, but the question is, should you be at the what the Fed calls lower end of neutral? I think it's lower than that. And so also if you think about later this year, unless oil prices plunge, the year-over-year comparison, the so-called base effect, is going to suggest that there is headline inflation. And so there's going to be headline inflation. And by the way, inflation expectations, that's something the Fed is watching, is very closely linked to the price of oil. So if the price of oil is holding up, inflation expectations are going to move higher, wage pressures are going to continue to persist, we're going to be ever closer to that boundary where we can't pull more people in. I think something is going to crack somewhere, and that is going to coerce the Fed to kind of keep pushing rates higher later this year.
Definitely, and you're saying that expected inflation is really contingent really upon the oil price. Can you expand on that?
Well, there are some quirks in the statistics. If you just look historically, put inflation expectations, market-based inflation expectations with the price of oil, there's a very high correlation. These are forward inflation expectations, like 5-year forward inflation expectations. That means the market thinks, but just because the price of oil is moving today, in 5 years from now, inflation rate is going to be higher. Now, if you think about it, it's absurd. But that's how the data show it. So if the data show, if the oil prices move higher, then if you ask an economist about what inflation expectations are, they tend to move higher with higher oil prices. Now, in defense of the Fed, if I can do that on your program, they look at so-called survey-based inflation expectations. And survey ones are when you actually ask somebody rather than look at what the market says. Mm-hmm. Those things don't ever move. And so with that, the Fed can do whatever they want. Now, not ever move is a bit of an overstatement, but they are very, very sticky. What I'm saying is that, hey, with wage growth at a very substantial level, and it's not just the higher wage earners, it's going throughout the economic ladder that wages are moving higher. And I have, on top of that, lots of anecdotal evidence that yes, people are jumping ship, moving to quote unquote better jobs. All of that suggests a hot labor market. And so if we keep pushing it with interest rates being at lower, what I think should be, well, at some point we're going to have an inflationary issue. I'm not suggesting hyperinflation or anything like that, but I do think that the Fed is very complacent. One of the things, by the way, I've been hearing a lot in the news lately is this thing called Goldilocks. We're in this Goldilocks environment. Well, the last time I heard that was ahead of the financial crisis. And so when I hear that and saying, well, maybe things are going to change. I mean, the one thing I think we all agree on, things are not going to stay the same. And I think the Fed would be quite well served to kind of heed that as well.
You said there was a risk of inflation in the future, not obviously like, hyperinflation or anything like that, but what kind of inflation are you looking at?
Well, it ultimately depends. As I indicated, right, wage inflation has been more than 3% a year now. And that's obviously not dramatic, but it's certainly higher than it had been for many, many years. And so the question is, well, what does that mean? It's quite common, by the way, in late stages of an economic cycle for inflation to pick up. And so what it foremost means that for corporations, they get squeezed, right? Because their input cost is going higher. Also, corporations internationally have been facing some headwinds. And so they're going to scramble to do what they need to do. And one of the things they'll try to do is, well, they'll pass on the higher cost to the consumer unless they can cut the workforce, but they can't when the economy is that hot, right? And so the question is whether we've reached that limit where they have to pass on the cost. And what the statisticians at the Fed say is, hey, just look at the last 10 years, there hasn't been an inflation problem. Well, yes, but we've been in a pretty unique environment the last 10 years. At some point, when you push something to be unsustainable, something is going to give. And it's not like then suddenly, inflation is going to go a tad higher. No, what's going to happen is that suddenly we are in this environment where wage pressures are higher, there are not enough people on the labor force, and things are going to kind of crumble. I'm not suggesting we're going to have a collapse or anything like that, but all these models only work in theory, in my view. In practice, things might pan out a little bit differently. We just don't know when that breaking point is. I just happen to think that the people from the sidelines, yes, it may work for a few more months, but at some point we can't push more people into the labor force.
Yeah, and if you can expand a bit on that, what is labor force participation looking like for you? And also, there's sometimes a controversy between whether we should be looking at the unemployment rate or labor force participation. What is your perspective?
Well, I'm glad that all your audience is trained economists, so let's go technical. Now, without getting too technical, when you talk about the labor force participation rate, it's the percentage of the population that's working. And you can slice and dice that in several different ways. If you want to have a consistent look at what's out there, many people looking at the prime age male labor force participation rates, and not to be sexist, but the reason they're looking at the men, because there's some consistency. With women, we've had over the decades, they joined the labor force when in the early 70s, and then we've had some backwards trends. So if you want to have a more consistent picture, you're looking at those prime males, so to speak, and in their prime earning years. And what we had for quite a while is that they were dropping out of the labor force. And so that was very concerning. It partially might have been the opioid crisis. Part of it was the financial crisis. And once you drop off unemployment, the way to still get benefits is you sign up for disability. And once you're on disability, the barrier to jump back into the labor force is higher. So that's part of it. And then we have the aging population, but also we have more old people working, right? I mean, as we get older, we're all productive, and so we can't afford to retire, but the positive way of phrasing it is that we can still contribute. And so there are all these different counter trends. And in recent months, we've been able, with this fairly strong economy, to nudge people back into the labor force. And the question is, and nobody knows the answer to that, how long can that continue? One of the things we do, we publish a bunch of chart books, and one of the things we do is we try to just look at the long-term trend and see whether that gets broken. And we're not quite there yet for breaking it. Once we break that, I'm going to be in the camp that I don't think we're going to get much further. So for now, yeah, we can last a few more weeks. The question is, just like for an investor, it's not about having a crystal ball, what will happen tomorrow. The question is, what is the risk that will happen tomorrow? And am I positioned appropriately? You do that with silver, I do that with my investments, and the Federal Reserve should do that with regard to interest rates. And the Federal Reserve at this stage says, I don't worry about that risk because inflation is not a problem, period. And to me, that's not a prudent way to look at it. And similarly on my end, well, I have to look at it, but okay, so this is how I see the world. These are the risks out there. Which risks am I willing to take? And they're saying, well, hey, there's a Fed that's not taking this risk seriously enough. How can I position myself? What can I do about that?
Definitely. And when it gets to like positioning oneself to, with respect to the economy going forward, what is your perspective like if we look at the major asset classes, if we look at the stock market or precious metals or, other commodities, like what is your perspective on where people should maybe be positioned right now?
Sure. How many hours do you have? Yeah, so let me first say I cannot give specific investment advice. So this is just general food for thought. And but in this context, everybody has their own way of looking at the markets. And the most important thing is to have a strategy. Even if it's not the ideal strategy, having a strategy is 100 times better than having no strategy. Because if you have no strategy, you'll just listen to the latest blog and you'll change your mind and you're almost certainly going to lose money. So one of the reasons why people look at the economic cycle, you asked me about the Fed, is because you want to know kind of when does this economic cycle turn over. Historically, in recessions, the stock market has done far worse than during expansions. Also, you mentioned precious metals. Precious metals historically, since the early 70s, have done very well in recessions, with the big exception of the early 1980s. The early 1980s was the period when Volcker pulled real interest rates to very high levels. And so in that environment, then gold may not do well. And so if you think we have a Volcker at the Fed, then you might want to stay away from precious metals. That said, what we think is that we are in late stages of an economic cycle, but we don't think we're tumbling over yet. And so as the Federal Reserve raises interest rates, one of the things that happens is that volatility moves higher. And the reason that's taking place is, think about QE, to take like an economic lessons here back. During QE, I said risk premia were compressed. What that means is perceived fear was taken out of the market. Everything seemed risk-free, right? And so as we quote-unquote normalize, if that's a term you can use, fear is coming back into the market. So this increased volatility we've seen is normal. And so, and the later we get into the economic cycle, the more it is normal to have higher levels of volatility. And so the question really is, do you want to pinpoint the top of the economic cycle and then go to cash? Or do you want to react to these increasing risks and gradually do something? I happen to be in a camp that now you might want to rebalance in this sort of environment, do things. Now, one of the reasons people, and by the way, as rates go higher, cash is not a bad asset often because you actually get something on it. But one of the reasons people are looking at gold is that it has a zero correlation to equities in the long run. And in that sort of environment, gold, I call it often the easiest diversifier. It's not always the best diversifier because of its zero correlation, because it doesn't always move in the opposite direction. But it is one of the few easy things you can do to get away from equities other than cash, because beyond that, you've got to have some long-short strategy. It gets really complicated. And one of the reasons gold has held up and even moved higher is, despite higher interest rates, is because on the one hand, real rates, meaning net of inflation, they haven't moved much higher. And then I mention all of this in the context of volatility. People often complain that, oh, gold doesn't have cash flow, right? It's just a brick. Well, the good news is when interest rates go higher and you have a so-called risk assets and equities, well, those cash flows, future cash flows get discounted more, and that puts downward pressures, headwinds on risk assets and equities. Whereas gold doesn't have the cash flow, so there's no greater discounting. And that's, in my view, just a kind of academic side, why gold historically does well as volatility moves higher, even as interest rates move higher, and why it's quite natural for gold to historically have done well as we end the near the end of the economic cycle. It's not that gold does the best when inflation is the highest. It's when you move in that sort of environment. And obviously, if inflation moves higher, if I can expand on that, quite often when inflation reading comes out, if you just take the dollar kind of at a more neutral level, or any other country, inflation comes out higher than expected. Often what happens, that currency strengthens. And any gold bug scratches their head saying, what the heck, inflation is higher, why the heck does the currency actually strengthen and maybe gold even goes down? Well, the reason that happens is because the moment inflation is higher, folks in the market say, well, the Federal Reserve or the Riksbank in Sweden or the European Central Bank is going to do the right thing and hike rates. So rate hike expectations are adjusted. Now, if the central bank then doesn't do it, then in the medium term, the currency weakens. But the immediate reaction is often, hey, our dear central bankers are going to do the right thing. And so that's why you often have not this clear one-to-one correlation when you have certain metrics come out. But to answer your question, I think we're in the late stages of an economic cycle, which historically means that you could have a blowout phase in the S&P 500, you could have a plunge. It's not certain. You can time that to perfection, and we actually try to do that pretty closely, but I'm not recommending that just like in 2000, right? Not many people were able to call the peak in the market. It's a process, right? Where we have this topping process, but you can have some amazing gains in equity markets, but I don't think it's for the faint of heart to participate in that, and so people might want to adjust that and then think of ways to diversify.
Right, it's very interesting. I mean, I remember, talking about a lot of this stuff probably, back in 2012, when we saw the Dow at, like 12,000. And I was thinking, oh, it's so overvalued and, move into precious metals. And yeah, I mean, I feel like that might still be I guess I was quite early, right, in that sense. And you could have ridden the stock market up quite a bit. It doubled after that. So as you're saying, I mean, we might still have a long way to go. We might have a blow off top in the stock market before it goes lower. But what is your perspective on, like, some people have said, it would be better to be, 7 years early than 1 second too late. So would you say that people should have a little bit of like insurance on the one hand, even if they're speculating a bit with the stock market?
Well, as you point out, different people have different views on that. And ultimately, every investor has to be comfortable with the choice that they make. I'm one of the guys who will rather be early. So I said, I don't like this. I'm more active. I don't want to be exposed to this. So I'm currently positioned to be, have minimal equity exposure, but I can do some things not everybody can do. I actually take positions on interest rates moving higher down the road, while I still have gold at the same time. And you'd think that they are opposite, but I actually think both can happen in practice. And so that I get a little bit of balance. And so I don't actually think the equity market can go much longer, but maybe in a short period, you just don't know, right? And again, it's not about what the market will do tomorrow. In my view, it's about the risk of the market doing something tomorrow. And so similarly, you mentioned 2012. It's about, if you take yourself back in time, you identified certain risks, you did certain things, and you needed to be comfortable with that, right? With hindsight, yeah, we're all geniuses. But we don't know what's going to happen tomorrow. And so it is possible that we coast along. It is possible the economy is going to go. Now, obviously, it's also possible, hey, if you look at the purchasing manager indices, Germany is slowing, China is slowing. Even in the U.S., we have a little bit of a slowdown, not significant. I actually happen to think that in the U.S., let's keep in mind one thing. The U.S. economy is 2/3 consumer spending. And indeed, I actually think the consumer is going to be doing better than corporate America, especially the S&P 500. International companies, they're exposed to the slowdown internationally, and they're going to be exposed to the higher wage pressures in the U.S. And so actually corporate America, in my view, is going to have more headwinds than the U.S. consumer. I just don't think a recession is imminent simply because on big metrics, the U.S. consumer is still healthy. Now, clearly, there are some increased defaults on some auto loans and some other things. But if you look at mortgages, the stuff that matters, those things are still very well contained. And I'm not saying that you don't see some minor warning signs, but historically, you need to push things a little bit further before things tumble over. Now, all that said, some recessions do come with a vengeance. And you look around and suddenly this has happened, right? And so those are certainly possible scenarios. I just happen to think that the Federal Reserve at this stage, they were spooked by the markets. They took a step back. I think they have to come back to the market, hiking rates later this year. And that then may well kind of get the equity markets to turn over. That's a possibility. I think their hands will be forced because of higher inflationary pressures. And so what to do about it, and you mentioned gold, right? The question is, or precious metals in general, how much exposure you want to have to it. And again, everybody is different. I always say that the best metric on whether you have a kind of an appropriate risk profile is whether you can sleep at night. And I'm not saying whether you can sleep with a brick of gold under your pillow, but if the volatility is such in any investments that you get restless, that means you're overexposed. And if I can expand on that, some people say that, at the end of 2008 or early 2009, you should have doubled down, gone all into equities. You can do that if you, on the way up, have taken the prudent step and taken money aside. But what most people do is they don't take chips off the table. So now you're overexposed to the markets, right? Let's say you have a 60-40 portfolio, 60% equities, 40% bonds. Over the years in the bull market, the equity portion has gotten bigger and bigger, which means you're more exposed to risk assets than you want to. Let the markets plunge. So now you've lost more than you're comfortable with. Does that mean you should double down? I don't think so. I think that's irresponsible. So the right thing, in my view, to do is that as equities go up, you take some chips off the table. You think of ways of diversifying, and you can argue whether that's cash, gold, some long-short strategy, or whatever it may be. But you want to de-risk your portfolio a little bit, and so that when then the bad times come, you can put money to work. Now, if the bad times never come, well, so be it. You've done a prudent choice in the context of what you're comfortable with.
All right. Well, Axel Merk, thank you so much for your time today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Well, sure. Come to merkinvestments.com. Follow me on Twitter. Connect to me on LinkedIn. Whatever your favorite venue is. We publish a lot of charts on the economy, on the business cycle, on the Federal Reserve, on many of those things. Our website, we have some investment products as well, including gold-related ones. But importantly, try to connect, sign up for a newsletter, whichever way it may be, so we can stay in touch, or come back to your program, and then we can continue the conversation.
Definitely. Sounds good. Axel, thank you so much for your time.
My pleasure.